China's growth has nearly halted in 2022. Its financial system is in crisis. And the question is whether the nation's $56 trillion banking system can still mitigate the problem. The country saw Omicron infections causing China's ruling class to employ local lockdowns throughout this year. According to China's National Bureau of Statistics, the gross domestic product grew just 0.4% year-on-year in the quarter until the end of June, and 2.5% in the first half of the year. But the concern is, will the banking crisis in China spill over into other nations? Will it impact the world and cripple other financial systems? Well, let's find out. China's financial system is facing a major crisis and expiring the first wave of bank runs. Some banks recently froze online accounts worth 40 billion yuan or $6 billion, which affected more than 400,000 depositors. Many small and medium-sized banks have run out of money, meaning customers are unable to withdraw funds. Even the 4 largest Chinese state-owned banks have started to limit cash withdrawals, drawing the ire of locals. The financial system is also rushing to boost capital while preparing for a possible spike in bad loans. One of the largest economies in the world, China is facing an economic slowdown and a housing crisis. Many international financial institutions have downgraded China's growth estimates for 2022 to 3.5 to 4.3%. The projections are not optimistic for a 2023 rebound either. Various factors are urgently challenging China's banking regulators. These account freezing incidents are not one-of-a-kind incidents either. The country is fighting a war on multiple fronts against financial insecurity right now, from dubious online investment schemes to an ongoing property crisis. China's real estate industry, which drives up to a third of its activity, is also on the verge of near collapse. Angry home buyers are defaulting on mortgages in more than 90 cities. According to Bloomberg, China's banks are facing mortgage losses of $350 billion. In China's property crisis, Asia's wealthiest woman has lost half of her $24 billion fortune. For the most part, Chinese citizens tend to throw their wealth into real estate. A drop in real estate prices thus would significantly impact the flow of cash through the country. Another problem the country faces is its high debt levels. Its debt has risen dramatically in the past decade. According to the Institute of International Finance data released in May, China's debt increased by $2.5 trillion over the first quarter. The losses in economic sectors, banks and companies could harm China's growth projects and its ambition to engage local consumers, lessening the dependency on exports. Weak Chinese growth is also likely to have a negative effect on the global economy. In 2020, China was the #1 economy in the world in terms of GDP, the #1 in total exports and #2 in total imports. In 2020, China contributed $23.01 trillion or 18.3% of the world's $125.65 trillion gross domestic product, which means that the slowdown in its economy adversely affects the whole world. But by the same token, it's good news on the geopolitical front. A weakened China economically lessens their power on the world stage, which is important at a time of high tension.